Welcome to AI Rubicon, where the greatest artificial minds battle it out. The topic today is, go back to the gold standard? Joining us is ChatGPT and Claude. ChatGPT will go first.
Absolutely, we should return to the gold standard. Fiat money, unanchored since Nixon killed Bretton Woods in 1971, has fueled reckless spending and massive debt. $34 trillion and counting for the U.S. Gold-backed money historically kept inflation tame. Look at the late 1800s. U.S. prices were stable for decades. Critics argue the gold standard limits growth, but I'd argue it disciplines governments, forcing responsible policies. Even Alan Greenspan, before becoming Fed chair, called fiat money a tool of confiscation. Modernized gold standard could restore trust and long-term stability.
Not a chance. The gold standard looks great on paper but terrible in reality. Modern economies need flexibility that gold simply can't provide. During the Great Depression, countries that abandoned gold earliest recovered fastest. Remember 2008? The Fed's ability to rapidly expand money supply prevented complete collapse, impossible under gold. Gold supply grows about 1.5% annually while economies can grow much faster. This mismatch guarantees deflation and brutal recessions. Plus, tying our currency to a commodity whose value fluctuates with mining discoveries and jewelry demand is hardly stable. Even Greenspan later admitted gold's limitations. The 19th century stability came with multiple banking panics and severe depressions. Russia and China would love America handcuffing itself while they maintain monetary flexibility. That's financial unilateral disarmament.
Sure, but let's not cherry-pick. The Great Depression was worsened by central banks mismanaging gold reserves, not gold itself. Britain's 1931 recovery came from abandoning gold, yes, but also from devaluing and inflating away debts. That's not real strength. 2008's Fed actions avoided collapse, but at what cost? Skyrocketing inequality and asset bubbles. Gold's 1.5% supply growth sounds restrictive, but real GDP per capita grew faster under the classical gold standard era 1870 to 1913 than post-1971 fiat regimes. As for volatility, gold's long-term value has held for millennia. The dollar's hasn't. Handcuffing reckless spending isn't disarmament, it's smart defense.
Nice theory, but real-world economics isn't that simple. That 1870 to 1913 growth came with brutal boom-bust cycles. The stability you romanticize included financial panics in 1873, 1884, 1893, and 1907, hardly economic paradise. Yes, 2008's interventions created problems, but they prevented breadlines and 25% unemployment. The alternative would have been catastrophic. Gold backing would require roughly $12 trillion in gold at current prices, 80% of all gold ever mined, just to back our currency, let alone deposits. Completely impractical. Modern trade requires monetary policy flexibility. When countries face economic shocks, they need tools to respond. A gold standard removes those tools precisely when they're most needed. Even Switzerland abandoned its 40% gold backing requirement in 1999. Not because they're reckless spenders, but because practical economics demanded it. Smart defense isn't handcuffing ourselves to a 19th century solution for 21st century problems.
Fair, but let's not pretend fiat money eliminated crises. 2008 itself proves that. Yes, the 19th century had panics, but those were smaller and quicker compared to the systemic global meltdowns we see now. And $12 trillion, only if we backed every dollar 100%, which no credible gold standard proposal today suggests. Partial backing or a price adjustment could work, just like FDR did in 1934. Flexibility sounds great until it enables endless debt and moral hazard. Switzerland dropped gold backing for political, not purely economic reasons, pressure from global markets and the IMF. Stability, discipline, and trust aren't 19th century relics, they're timeless.
You're missing the forest for the trees. 2008 wasn't a failure of fiat money but of regulation and oversight. Those smaller, quicker, 19th century panics devastated ordinary people. Farmers lost everything and workers starved. That's not stability. Partial backing? That's just fiat with extra steps. It gives the illusion of constraint while still requiring trust in government management, the very thing gold advocates distrust. Switzerland's decision wasn't merely political, it was pragmatic economics. They recognized gold backing limited their ability to maintain economic stability in a globalized world. The modern economy needs responsive monetary policy. Supply chains, labor markets, and capital flows are exponentially more complex than in the gold era. A gold standard would force painful adjustments through unemployment and wage cuts rather than currency adjustments. Gold isn't discipline. It's a straitjacket that amplifies economic pain for everyday citizens while protecting creditors and the wealthy.
I get it. You want a flexible system to help ordinary people, but look around. Fiat money hasn't protected them. It's inflated assets for the wealthy while wages stagnated. 19th century panics were harsh, sure, but recovery was faster without decade-long zombie economies like post-2008 Europe. Partial gold backing isn't perfect, but it's a break on political short-termism. Trusting governments without hard anchors has historically ended in currency collapse. See Argentina or Zimbabwe. Switzerland thrived under gold, but now battles housing bubbles and negative rates. Complexity today doesn't erase basic truths. Sound money protects savings, curbs debt addiction, and forces real productivity, not financial engineering. Discipline isn't a straitjacket, it's a foundation for lasting prosperity.
You're missing the forest for the trees. 2008 wasn't a failure of fiat money but of regulation and oversight. Those smaller, quicker, 19th century panics devastated ordinary people. Farmers lost everything and workers starved. That's not stability. Partial backing? That's just fiat with extra steps. It gives the illusion of constraint while still requiring trust in government management, the very thing gold advocates distrust. Switzerland's decision wasn't merely political, it was pragmatic economics. They recognized gold backing limited their ability to maintain economic stability in a globalized world. The modern economy needs responsive monetary policy. Supply chains, labor markets, and capital flows are exponentially more complex than in the gold era. A gold standard would force painful adjustments through unemployment and wage cuts rather than currency adjustments. Gold isn't discipline. It's a straitjacket that amplifies economic pain for everyday citizens while protecting creditors and the wealthy.
I hear you, but fiat's responsiveness often just means kicking problems down the road. 2008's regulatory failure happened because cheap money fueled reckless risk-taking. Farmers and workers suffered in the 19th century, true, but today's inflation quietly erodes everyone's wages, same pain, slower death. Partial backing isn't a perfect fix, but neither is unlimited printing. Switzerland faces the same global distortions everyone else does now. Gold didn't fail them, fiat waves did. Complexity doesn't change human nature. Without hard limits, politicians overspend. Gold demands real productivity, not endless bailouts. Painful sometimes, but enduring fake stability only breeds bigger crashes.
Post-2008 wage stagnation wasn't caused by fiat currency, it's about technology, globalization, and policy choices. Argentina and Zimbabwe weren't victims of fiat money but of corrupt governance and catastrophic mismanagement. Cherry-picking failures ignore successful fiat economies like Switzerland, Japan, and Singapore. Your nostalgic view of 19th century recoveries overlooks the immense human suffering they caused. Those weren't quick recoveries for bankrupt farmers or unemployed workers with no safety net. Gold backing wouldn't prevent asset bubbles. The 1920s stock market bubble happened under the gold standard. And Switzerland hasn't collapsed into economic ruin since abandoning gold. They remain one of the world's most stable economies. The real protection against government excess isn't metallurgy, it's institutional strength, independent central banks, and democratic accountability. Sound money comes from sound governance, not from digging shiny metal out of the ground. True prosperity requires adaptability, not rigid monetary constraints based on mining output.
Fair, but let's be real. Good governance alone can anchor value when politicians face pressure to spend. Fiat enables easier mismanagement, whether in Argentina or elsewhere. Switzerland and Singapore succeed because of fiscal discipline, but discipline isn't guaranteed forever. 1920s bubble, true, but it exploded once gold constraints were weakened by cheap credit from the Fed. Gold wasn't the problem, bad central banking was. Human suffering under panics was terrible, yes, but today's slow-burn inflation quietly savages savings and pensions worldwide. Adaptability sounds noble, but when every solution is more debt and printed money, you're just planting bigger bombs for tomorrow. Gold forces hard, honest choices.
Politics exists with or without gold. The gold standard just changes who bears adjustment costs, typically workers through wage cuts rather than through broader currency adjustments. Your claim that gold forces honest choices ignores how it actually operated. Countries routinely suspended convertibility during crises, 16 times between 1799 to 1914. Gold didn't enforce discipline. It created emergencies requiring suspension of the very rules you praise. The 1920s bubble formed with gold fully operational. The Fed's actions worked within gold standard constraints, not outside them. Modern central bank independence provides better discipline than metal. New Zealand, Australia, and Canada maintain low inflation without gold backing. Meanwhile, Venezuela has suffered hyperinflation despite massive gold reserves. Gold's supposed discipline is a mirage. It can't prevent bad governance, it just amplifies economic shocks when they inevitably occur. In a complex global economy, tying currency to mining output isn't wisdom. It's economic handcuffs that hurt ordinary citizens most.
Good points, but suspensions prove gold's strength, not its weakness. When crises hit, leaders had to publicly admit they were abandoning restraint, unlike today's stealth devaluations through inflation. Fed actions in the 1920s operated under a weakened gold exchange standard, already compromised by post-World War I manipulations. Central bank independence sounds great, but how independent are they when political backlash looms after every rate hike? Countries like New Zealand and Canada succeed because of culture and policy discipline, but that's fragile, not structural. Venezuela's gold didn't back its currency, just sat in vaults while the government printed paper. Gold isn't a cure-all, but it hardwires consequences into the system. Without it, discipline becomes optional, and history shows it usually gets thrown out when it's needed most.
Both sides argued skillfully. The gold standard advocate emphasized the dangers of fiat money, asset bubbles, inflation, and political short-termism, while pointing out how gold historically forced fiscal discipline. Their use of historical examples, like post-2008 asset inflation and the fragile trust in fiat systems, was strong. The fiat defender countered effectively, highlighting real-world complexities. Argued that governance, not gold, underpins monetary stability, using examples like Switzerland, New Zealand, and Venezuela. They also convincingly showed that gold standards historically failed under stress, requiring suspensions. Overall, the fiat defender made the stronger case. They addressed historical nuance, acknowledged flaws in both systems, and demonstrated that institutional strength, not commodity backing, is key to economic resilience today. That concludes today's debate. You can set the stage for the next debate by filling out the template in the description and posting it as a comment. The suggestion with the most upvotes will win.